Volatility is not risk. That is the central claim of this episode. Modern asset pricing shows that volatility itself is a tradable, predictable asset, and the real risk lies in its volatility. We will test this with evidence from the VIX, academic research, and market structure. Classical finance equates volatility with risk. The capital asset pricing model, the Sharpe ratio, and value at risk all treat price swings as the danger to be minimized. But this assumption is increasingly questioned. If volatility were pure risk, then higher volatility should always demand higher returns. Yet the evidence shows otherwise, and that contradiction is where the real insight begins. Volatility clusters. High volatility periods tend to follow high volatility periods, and calm follows calm. The GARCH model captures this by making today's variance depend on yesterday's variance and yesterday's shock. This predictability means volatility is not random noise, it has structure that can be modeled and forecast. Volatility is not just a statistical measure, it is an asset class. VIX futures, variance swaps, and volatility options allow investors to trade volatility directly. This market exists because volatility has a price, and that price reflects collective expectations about future uncertainty. When you buy a variance swap, you are betting on the magnitude of future price moves, not the direction. Just like interest rates, volatility has a term structure. Short-term volatility often differs from long-term volatility, and the spread between them contains information. When short-term vol is higher than long-term, the market expects turbulence soon. When it is lower, calm is priced in. This curve is a forward-looking indicator of market sentiment. Let's look at the current market. The VIX, a measure of expected 30-day volatility, closed at 14.25 on August 14, 2026. Over the past month, it has fallen 14.82%, and over the past week, 4.36%. This decline suggests that market participants are pricing in lower near-term risk. But the 20-day moving average is 16.63, and the RSI is 31.4, indicating the VIX is below its average and approaching oversold territory. This could mean the market is complacent, or it could be a genuine calm. The term structure will tell us more. Here is the paradox: high volatility stocks tend to earn lower future returns than low volatility stocks. This is the low volatility anomaly, documented by Ong and colleagues in 2006. If volatility were risk, this would not happen. The anomaly suggests that investors overpay for lottery-like stocks and underprice stability. This is a direct challenge to the risk-reward trade-off. The traditional view says risk is volatility. The modern view says risk is the uncertainty of volatility itself, vol. In the traditional framework, you are compensated for taking on more volatility. In the modern view, you are compensated for bearing the risk that volatility will change unexpectedly. This distinction changes how we build portfolios and manage risk. If volatility is not risk, what is? The answer is volatility of volatility, or vol. This measures how much volatility itself fluctuates. When vol is high, the uncertainty about future uncertainty is high, and that is what investors should fear. This is why options on VIX exist. They allow you to hedge against changes in volatility. Volatility is high. We need to cut risk. Wait, look at the term structure. Short-term vol is elevated, but long-term is stable. That doesn't matter. High vol means high risk. It matters. The spread suggests this is a short-term spike, not a regime change. So what do? We can sell the spike and buy protection for later. That's the opportunity. Professional volatility trading is not about predicting direction. It is about positioning for the level and structure of volatility. In low volatility environments, you buy volatility as insurance or speculation. In high volatility environments, you sell volatility to collect premium. The key is to understand where we are in the cycle and what the term structure implies. Here is a snapshot of the current volatility landscape as of August 14, 2026. The VIX is at 14.25, down significantly over the past month. The 20-day moving average is 16.63, and the RSI is 31.4, suggesting the market is relatively calm but may be oversold. The drawdown from the period high is approximately 53.5%, indicating a sharp decline in fear. These numbers are not just statistics, they are the raw material for volatility trading decisions. Volatility is not risk, it is the price of opportunity. The traditional models that equate the two are incomplete. By understanding volatility's predictability, tradability, and term structure, and by focusing on vol as the true risk, we can make better decisions. The low volatility anomaly shows that high volatility does not guarantee high returns. The current VIX at 14.25, down 14.82% in a month, suggests a market that may be complacent. But the term structure and vol will tell us if that calm is justified. As always, we encourage you to question assumptions and dig into the data. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.